Hi everyone, welcome again to another company analysis video with myself, Moeed Amin, and Ted Wayman. So today we're going to be looking at a well-known company, Microsoft. Now, not much of an introduction needed. I think most people know about Microsoft, but there is some context behind this business that I think is very interesting, especially as we start to dig into the financial statement and the analysis behind that. So obviously a company founded in 1975, and they're involved in a whole range of things related to technology and digital, from hardware like laptops and PCs to the Xbox and games consoles and phones and their own smart glass, software, web-based applications like LinkedIn and Skype and Outlook, and their own cloud service, storage service like OneDrive. Now, what's interesting about this business, if you look at their last quarterly statement, now we're not going to look at the quarterly statement, we're going to be looking at their audited annual report, but the analysis you're going to get from us is going to help you really quickly and intelligently analyze those future statements. But what's interesting from the last quarterly statement is the biggest growth that they saw were in divisions of the business like LinkedIn and cloud services, which kind of makes sense. What was interesting are the areas that they're seeing lower growth are places like Office 365, Azure, which is their kind of enterprise security software service, on-premise server businesses, which makes sense because the industry is moving more towards cloud. And what I thought was really interesting was gaming, actually, constrained console supply, as they described it. And I think less in terms of subscription numbers, although it's worth digging into that. What's interesting, though, is that the number of hours, what they call engagement in the gaming platforms and gaming kind of services and solutions, is still the same as it was last year. So there seems to be something going on there in terms of the revenue that they're getting from that. So I thought that was very interesting and worth looking at. As with a lot of international companies, obviously the war in Ukraine is going to have an impact on them, and they estimate that to be about $110 million. So again, look out for that in the future statements. They've also been on a bit of an acquisition hunt. Now, they recently acquired a company called Nuance Communications, and they're involved in conversational AI and what they call ambient intelligence, and they acquired them for $19.7 billion. They also acquired Activision Blizzard for 64, I think it was billion dollars, or 67, and that's a financial statement that we also analyzed. So look at past videos on Activision Blizzard. So all of this is pretty interesting, especially when you're looking at the financial statement. If you're an investor or thinking about investing in this company, or even if you're selling to a company like Microsoft, it's worth having that context. A few notes on the share price, again, important, and we're going to cover that in more detail as we go through the financial statements. They IPO'd in 1986 and IPO'd for 10 cents a share. If you'd held on to that investment, you'd be sitting on, get this, about 847,000% increase. Now, we've seen companies in the past that we've analyzed at 3,800, 4,000. But these guys have won. They take the top spot, 847,000. Benefit of hindsight for sure. If you invested 5 years ago, you'd be sitting on an increase of 247%. And if you invested a year ago, you'd be sitting on a decline of 5.7%, which actually, when you think about other companies out there, particularly companies in the tech sector and tech industry, that is absolutely not bad compared to some of the others that have seen a drop of 90% or even more than that. So they've certainly weathered the downward trend that has been facing a majority of the companies out there. And again, we're going to look at the finances and see, does it say anything about that? Probably not, because it's a backward-looking statement, but worth having that as context. So there you have it. Very quick introduction into Microsoft. I'm going to pass over to Ted now, and he will share what we've uncovered about this business and help you really smartly analyze financial statements of a company like this and any others.
Well, good to see you, Moeed, and welcome to all of our viewers. I hope you are all well. Don't forget to like, share, and subscribe to the channel. So click the subscribe button. Like the video if you like it, share it with your colleagues, share it with your friends. Let's grow this channel. Let's increase people's awareness of being able to speak the language of business finance, as Warren Buffett talks to us, and that's what we're trying to do here. So we are talking a little bit about share prices, but this is not primarily investment advice. In fact, we're not qualified to give you advice. We're only qualified to give you our opinion, and our opinions are not always right. Otherwise, I wouldn't be sitting here. I would be sitting on a super yacht somewhere in the Caribbean. So here is Microsoft's annual report. Now, quite like Microsoft's annual report, because it's the first one I've come across, which is in a Word document. Good old Microsoft, it's in a Word document. And so if you think that the annual report 2021 is a bit out of date, then you could just very simply just turn it and change it into annual report 2022, although I'm not sure that's strictly legal. So let's stick to 2021. So it's not even a kind of protected document. It's a Word document, and you can play around with it if you want, which I thought was quite interesting. Most people put it in PDF, but then of course, I don't think that Microsoft is going to put their document into a PDF. So let's whiz through this report, this Word document, all the way down to the numbers. Here are the numbers, and this is where we are going to be focusing. So here we are looking. We're looking at the left-hand column, 2021. We are in dollars, and we are in millions of dollars. So revenue, which is a combination of both the products that they are selling and the services, total of $168 billion. $168 billion. That is a 20% increase year on year. And you'll see that that is also increasing from 2019. So these guys, very pandemic proof. Everyone's now on Microsoft Teams, and you know, if they're not on Zoom, they're on Microsoft Teams and other kind of you know, online paraphernalia. So these guys really have benefited from that. The cost of revenue is pretty small, about 30%, which leaves them a really nice, big, juicy gross profit, $116 billion, gross margin, about 69 to 70%. So very, very profitable. A feature now of these tech companies, they always like to tell you about the R&D. They always like to say, look, you just need to know that we, Microsoft, are spending about $21 billion every single year investing in the future. We're not trying to stand still. We're not just saying, look, we're here with that, you know, we don't have to do anything. So Windows, whatever the next, you know what, I'm not on Microsoft. Full disclosure, I'm an Apple man myself. You know what they say, once you go Mac, you don't go back. But hey, I never quite got my head around. It's ever since that dancing paperclip. That was it for me in Microsoft. But anyway, I digress. These guys are researching, they are developing, they are investing in the future. There's a lot that they're spending on sales and marketing, and then the kind of the back office, general administrative, about 5 billion. You know, actually, you know, as a proportion, very, very small amount. No interest means no debt, but they do have a little bit of other income, and they are paying their taxes. Only about 14% effective tax rate, but they are paying their taxes. So somebody in the tax department is being very clever at you know, making sure they don't pay too much in tax. So sum total, very profitable company. 61 billion on turnover of 168 is a 36% net margin. Very, very profitable company indeed. Let's go and have a look at, and you'll notice here the earnings per share up from 5.28 to $8.12. So a nice healthy increase in the earnings per share. Let's go and have a look at the balance sheet, which is down here. Here's the balance sheet. So first of all, we're looking at the assets. So the non-current assets are the things we need to run the business. That's here. Look at the big numbers in there. We've got things like goodwill, because Microsoft has grown by buying other companies. They've got quite a lot of property, plant and equipment. A lot of that will be kind of all their cloud computing and web servers. And they've got a few right of use leased assets and other bits and pieces in there. That's a total of about 149, nearly $150 billion if you add all those numbers together. And you can compare that to their current assets, which are these numbers here. And in their current assets, really what's standing out is that they just have a ton of cash. I mean, 130 billion of cash just sitting there. 38 billion of accounts receivable, no inventories because they don't, you know, they got, you know, a few bits and pieces on the shelf, but not a lot, and a few other bits and pieces in there. So, you know, really just, you know, lots and lots of assets and you know, a big cash pile sitting there waiting to be used. On the bottom half of the balance sheet, looking at the liabilities and the shareholders' funds, the current liabilities. Here's the current liabilities. These numbers here. So we've got things like accounts payable. They've got a little bit. They do have a little bit of debt, which is quite interesting. I say a little bit of debt. I mean, they've got 50 billion plus 8 billion. So it's interesting that we didn't actually see any interest payable. Maybe I missed it, but so it's interesting. So again, we got this other operating. They talk about this other operating income net, okay, which is basically the way to think about that is the difference between the interest they pay and the interest they receive. Now, most companies will split that out, but these guys don't. And obviously, they are earning interest on this money here, and it outweighs the amount of interest they're paying on their debt. So they do have debt. There it is. It's these two numbers added together. So about, what's that, nearly $60 billion of debt, but the amount of interest they earn on their investments outweighs the interest they pay on their debt. So that debt is not a problem. It's easily affordable. What else have they got in there? So current liabilities, a little bit of accounts payable, 15 billion. Those are the suppliers who haven't been paid. They've got some unearned revenue. It's a pretty big number there. Okay, and that is revenue that they receive. They receive it today, but they earn it tomorrow. So that'll be things like people paying for cloud services, for example. Okay, and that means that these guys will be generating lots of cash. So 41 billion of people paying them in advance of receiving the good or service. I wish my clients did that to me. Most of them, in fact, all of them say, Ted, you run the workshop and then we will pay you. But in a good environment, they would pay me and then I would run the workshop. That'd be good for my cash flow. Unfortunately, it is not the reality. What else we got? Got some long-term unearned revenue, not a huge amount. That's this number here. Some income taxes that they got to pay, sort of deferred tax, debt, and a few other bits and pieces as well. So sum total is that they've got total assets of $334 billion. They've got total liabilities of about $192 billion, and the difference between the two being $142 billion is the equity. So that's this number down here. That's the kind of, if you were to put them into liquidation, that's what you give back to shareholders. Obviously, you're not going to, because they are generating lots and lots of profits. And that is made up of the investment by the shareholders, 83 billion, and the retained earnings. So these guys have got a substantial amount of retained earnings. Now, once again, we can see they made 60 billion in profit during the year, but their retained earnings has only gone up by just over 30 billion. So that means they must have done something with that profit. They've either given it back to the shareholders through share buybacks or through dividends. And we can see what they've been doing by looking at their movement in equity. And we'll just jump down to the movement in equity. Here it is. So the movement in equity 2021 again, and we can see there's the 34 billion that they started with. There's the profit during the year. And look at this. They are paying out a dividend and they are buying back their own shares. So in effect, we've seen companies who are paying out dividends. We've seen companies who are using profits to buy back their own shares. These guys are doing a little bit of both. They are providing a dividend to people who want income, but they're also buying back their shares, which increases the value of their shares. And that's how they get to that balance at the end of 57 billion. So there's the movement in equity. Let's go and have a look at their cash flow last little bit. And we'd expect to see some pretty strong cash flow, and we're not going to be disappointed. So there we go. Net cash flow from operations, nearly $77 billion, up from 60 billion, up from 52. So, very, very good, very strong cash flow. And really the big difference there is that it's the profit, add back the depreciation, and you get the cash flow, which is why often people talk about EBITDA being a very close approximation to the cash flow of a business. We got the financing and investing. Now, I got caught out by this because every other set of accounts that we've been looking at, the financing is coming down here. So you look at the investing and then you look at the financing. And these guys have got financing and then investing. So I'm going to analyze it in the way you'd normally find it. So let's look at the investing first. Purchases of investments, maturities of investments. These, as you will remember, are sort of basically just movements in cash. This is like parking surplus cash on deposit and then taking cash off deposit. So you kind of need to, and actually you probably need to sort of, build in those three numbers. And so really what we're interested in, the investing, is this line here. This is what they are buying in terms of property, plant and equipment: 20 billion, 15 billion, 13 billion. So they are investing. And what you might notice here is that the additions are greater than the depreciation and amortization. So there's the depreciation and amortization. So they're growing their business pretty rapidly. And then how are they financing it? Well, you'll notice the common stock issued and repurchased. So there's the buyback of the stocks that we saw earlier. They are paying dividends to the shareholders. There we go. And there's a little bit of kind of, repayments on debt, for example. Nothing really sort of significant. So 48 billion is really all about just returning a surplus cash to the shareholders. So these guys really are paying out cash, and you'll notice that actually the difference in the cash at the beginning of the year and the end of the year, the kind of the net cash flow, or the change in cash, is pretty small for this company. They're kind of maintaining amount of cash, but they do have a lot of money parked in those marketable securities. So if you're doing your analysis, you probably want to kind of to take that into account in terms of its cash flow. So company's looking pretty good here. Let's go and have a look at the share price and see what that has been doing. So here is our share price. As Moeed said, benefit of hindsight. Just fill your boots when they floated back in the days of yore, and just hold on tight, and you'd be sitting on a super yacht moored up against Bill Gates, no doubt. So EBITDA margin 50%. The debt isn't an issue. The ratios are almost sort of meaningless. These guys, they've got a lot of cash, very, very strong. They're going to weather the storm, unless somebody comes up with a kind of, a complete, it's going to be competition that's going to kill them, not kind of lack of, ability to run the business on a financial basis. So here we see the market cap of the business. Another a trillion plus company here. This one is about 1.9, so just shy of $2 trillion in total. That's a PE ratio of about 26 times, which is, if you kind of turn it upside down, that's an E to P, a yield of about 4%. Now, 4% pretty low, especially in an inflationary environment, and that's probably why this company has just taken a little bit of a dip here. Like all tech stocks, in fact, like the market as a whole, as the markets are being spooked by inflation, everything's taking a tank. However, companies which are all about jam tomorrow are going to carry on down here, but Microsoft is very much jammed today, and therefore there's going to be a support line at some point that's going to hold for these guys, and that's where if you're looking to kind of time the market, you might want to be thinking about where you buy in. So you might want to be thinking about, what's the trend? This is a kind of this is a lovely arc, isn't it? But it certainly isn't going to kind of carry on doing that. So maybe you're kind of looking at something like this. Maybe there's a little bit more to fall. Who knows? Maybe this is a good opportunity. But P ratio of 26 is not cheap. It's not crazy expensive, but it's not cheap. Long-term average for the US, 15 times earnings. So these guys, they are overpriced, but they're a pretty good company, and that's why they are. That's why they're expensive. Dividend yield pretty small at about kind of just 1%, but that's only because they only pay part of their dividends out. So if you include the dividends and the share buybacks, you're up at about a 2% yield. So that kind of gives you a feel there. It's basically all goodwill. I mean, that $1.9 trillion is all goodwill. The balance sheet's only 142 billion. So it's very much you're kind of investing in the Microsoft, the brand, their expertise. It's a brilliantly run company that they are absolutely fantastic. I hate their products, I have to admit, but I take my hat off to the company itself. It's I've got they own Google. In fact, they own YouTube as well. I think we have to be careful here. But I have multiple Microsoft login accounts, and I can't work out how they all work. But anyway, that's my little rant. I'm too old for this stuff. So you will see, you remember we looked at the price to the earnings per share. We looked at the growth in the earnings per share from $5.82 to $8.12. That's a 40% growth. And therefore, if you look at the PEG ratio, that's the PE to growth ratio, you're at about 0.78. Anything below 1 looks like a buy. But then a lot of that earnings per share is driven by share buybacks, as well as growth in the underlying business and the underlying earnings of the business. So final conclusion here is this a buy? Well, it's not in my portfolio. Should it be in my portfolio? It certainly should have been in my portfolio back in 1990 when I graduated from university. What I should have done is taken all of the money that I wasn't earning and invested it in Microsoft and held on, but I didn't. In fact, you could go back to the old, you remember the .com boom and bust, Moeed? Look, that's there. So that's when a lot of people are going to go, oh my gosh, you're in Microsoft, you've lost your shirt, sell, sell, sell. And there's going to be a few people who just go, no, you know what, I'm just going to stick with it. I'm just going to hold on. I'm going to ride out the bumps. And that's kind of where, a lot of investors, long-term investors, should be thinking about today. Don't try and time the market. It's a mug's game. So, if it's bumpy out there, just, don't look at your portfolio. Just ignore it. It doesn't matter. Just leave it for a few years, and, and things will sort themselves out, and they will come back. You want to, maybe sort of think about rebalancing sometimes, but, don't try and, my personal opinion is don't try and trade the market. Don't try and time the market. Certainly don't use my analysis for your day-to-day trades. There's lots of day trading software out there who will take your money on the spread and the commission. That's an opinion, by the way, not advice. So is it a buy? Honestly, I don't know if it's a buy or not. It's expensive, but it's a great company, and that's why it's expensive. It probably, it's not a screaming buy. It's not a screaming sell. It's probably something which you might want to have it on a watch list, and if it gets crazy cheap, just because it's caught up in the market route, then maybe you want to kind of grab a few shares in Microsoft. But otherwise, I think that it's probably part of a nicely diversified portfolio. And it's not going to double and double and double again. Because there's going to become a sort of a $quadrillion company, and it's going to take over the world, and the Monopolies and Mergers Commission will get all over it and start trying to take it apart. So it's I'm not saying you've missed the boat, but the boat is it's kind of floating downstream. There's no kind of there's no big excitement to come. At least that's my opinion, and I'm happy to be proved wrong at some point in the future. So there you go, Moeed. That's basically my call on Microsoft. Very well run company, lots of cash, strong balance sheet. Can't fault it. Just wish I'd been able to take this presentation back with me about 30 or 40 years, give it to my younger self, and say, there you go, make the investment. Yeah, and a couple of things to note. It's actually Google that owns YouTube, not Microsoft. You're absolutely right. Google owns. Yeah, and I made the mistake where I said 847,000% increase. It's actually 347 at the time when I looked at it. So apologies for that. But hey, we're not here to make predictions. We're here to help you analyze financial statements. So love to hear your thoughts. So do leave a note in the comment section. Make sure that they are polite. And if you have a company that you are really interested in understanding the finances of, and you would like us to analyze their finances for you, do leave a note in the comment section. This particular one wasn't a request. However, about 98% of the videos we publish are requests. So leave a note in any of one of the comment sections and put some context. Describe why you're interested in this company. The more interesting the description and reason, the more likely we're going to prioritize your video. And if you're a subscriber, you will get a notification of when we publish your video. So until the next video, thank you, Ted. Thank you, everyone else. Good to see you later, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.